Now that we've identified the highest price point at which institutions were buying and began to sell, and we also identified the lowest price point where institutions were selling and then decided to start buying, we now need to narrow that down to an area or a zone. And the reason why we want to do that is because we're trying to pinpoint as accurately as possible what price are the institutions targeting. When you and I buy something, we're targeting a very specific price. And in order for us to at least have some indication or idea of what that price is, we need to narrow it down to a zone. So because we've identified by looking at the 2-week chart, we were able to identify what the trend was. We see that it came down here, and now the trend is on its way up. We even can kind of see from here. Now, you don't want to get into the habit of depending on what this says. You want to get into the habit of recognizing where it started, where it ended, because then that tells you where it's headed. And we now know it's in an uptrend. So because it's in an uptrend, we want to pay more attention to the area here where institutions will begin selling. So the way we mark off a zone is by first putting the horizontal line, of course, at the top of the monthly market reversal. And the way we're going to identify this is looking at this candle here. Because we're trying to find the area where they're going to begin selling, we want this candle to be green, just like our horizontal line is green. Okay, so because this candle's red, we want to drill down and go to a smaller time frame. So let's go to the 1 week. And there we have it, that quick. We already have a green candle. So what we want to do now is grab another green horizontal line, and we're going to look to see where is the highest wick on the chart. And there's the highest wick right here. Why are we doing that? Because wicks are an indication that institutions have unfilled orders. What that means is, as the market was going up and institutions were doing a lot of buying, they were buying from novice traders who were selling. And so when they got to right about this area here where you see the beginning of the wick, they were struggling with trying to get these orders filled. And so what we see is they would go back again and try to get the orders filled. And we see here, so all orders in this wick up to this point here are all filled. You can even use historical information as well, but for the sake of simplicity, I just want to show you that when the first time they go up and it creates a wick, those are unfilled orders. But when they go back a second time, because the number of wicks are even, that lets you know they went up another time to try to get those orders filled. And so we don't want to look at the wick below this point here. Because I see this is higher than this one here, so this area here is higher. So what I want to do is I want to then look at this from the standpoint of what's in this wick. What in this wick has not been fulfilled? We want to narrow it down to that. And right now we see that this is all what we call fresh. There's nothing in here to indicate to us that these orders in here are filled. But the problem is we're looking at a zone that's very large. Again, this is a 1 week time frame. And this zone that we've identified here is from 115.13 to 115.71. So you're talking about roughly 55, probably about 57 or 58 pips, something like that. So that's just over 50 pips. So this is too much as far as a range. We want to be within a 20 to 25 pip range when we're looking for a zone. Whether we're looking for the zone up here where institutions are selling, or the zone where institutions are buying. So let's go ahead and drill down some more to narrow down this area. So let's go to the 2 week or 2 day, I'm sorry. And when we go to the 2 day, we can see something unique here. And we always want to identify our zones by looking at a green candle with a red candle next to it. Why? Because it's a clear picture that the institutions were driving the market up by doing a lot of buying. And when they could not buy from anyone else, they started to sell what they had, causing the market to come back down. And it creates this little pivot point. And so we see the green going up, the red going down. We never want to use a zone that's opposite of this because it's not a clear indication of what took place. Even if it may work, you do not want to be in the habit of that. You want to stay clear of that and have a very clear picture. So we're going to move this up because now we see that more of these orders in the wick have been fulfilled up to that point. And now we see this area up here is fresh. This area up here has not been touched. And when we look at the price range, we see 115.39 to 71. So you're talking about a 32 pip range here. That's still too big. We don't want to be 32 pips in the range. We want to narrow that down. We want to get as close as possible to the price we think the institutions are going to target. So now let's go down to the 1 day chart. And now that I'm down to the 1 day, what I'm looking at here is I'm going to show you guys a little trick. Because this candle came first, and it's right next to it, because this candle came first and they went up, it goes to show they were only unable to get these orders filled. So when they came up a second time, they were not able, I'm sorry, to get these orders filled. So when they came up a second time, they were able to get these orders filled. They attempted to try to get more filled higher, but were unsuccessful. So what I could do is I can actually take this, rather than using a candle in front, I could use the candle behind it because it's right next to it, and I could actually lift this up here. Because this candle is the same time frame, same history. This is all in the same area. You don't want to be looking way, way, way in the past. So those two don't have much to do with one another. So we want to stay current. And so we're looking at this here, and we see that this is the area we want to target. But the issue we have with this is what I said earlier. We want this candle, which is our monthly market reversal candle, to be green, and the one to the right of it to be red. So let's go ahead and drill down some more. Even though we're looking over here and we can see the price is 115.55 to 115.71, you're talking about a 16 pip range, which is very good. We can pretty much be done here, but unfortunately our candles are not in order. The candles have to be in order as well as the range. So let's drill down some more. Now before we drill down, I'm going to put a vertical line over the candle that we're targeting because I need to see the date at the bottom. That date says January the 10th, 2019. So I'm going to right click, I'm going to go to date, or you can just go to date at the bottom of the screen. So you'll see go to, and then that'll take you to the date as well. So we're going to go back to January the 10th, 2019. We're going to click this. And now we have our date saved, as you can see. So next time I need that, I can just go to and it'll already be in there. So now let's go to our lower time frame. And now you can see the reason why we selected our date, because now I can't see the candle we're looking at. So I have to go to January 10th is already saved. I can select it, and now it's going to take me to the area that we're dealing with here. On the 12-hour chart, I still see the same problem. So we have a nice range, but we still have the same issue with the candle. So that means we need to drill down again, and we're going to go now to the 8-hour. Again, I can't see the candles that I'm working with, so I'm going to hit go to, and I'm going to target that area. And now we have a beautiful picture, and we have a beautiful range. And what I'm going to do now is refine it by raising this up here to about that point. And then I'm going to leave this alone. Now, we made a mistake in starting. Before you start, or you can do it anytime you want, but just make sure you get it done. Of course, I'm doing it after the fact, but it's good to be in a habit of doing it before so you don't make the mistake. But since we're looking at an area or a zone where institutions are going to begin selling, that's what we want to do. We want to follow in the footsteps of the institutions. And so in order to do that, we should be selling as well. So that means we need to be looking at the asking price. So I'm going to switch that to ask. And you can see there was a slight movement here on the chart. We have the price at $1.1571. And I'm going to change this here to $1.1561. Now the reason why I'm doing that is because there's a few things I want you guys to recognize. When you are looking at the market here, want you to understand there are some theories that institutions use. And in order for you to be able to fully recognize whether or not you have the right zone, a couple of things have to come into play. Not only do you have to be within a 20 to 25 pip range, you also have to have your green candle here and your red candle to the right of it. All this information has to be fresh. And then the actual prices that are selected to identify your proximal line and your distal line, those numbers have to fall within one of these theories here. Now, let me back up. When I say proximal line, because the market's going to be coming up here, a proximal line is the line that is within proximity to the current price, or it is closest in range to the current price as the market's going up. So if I go back to the beginning here and we were to pull all of this in here, as you can see, the market's on its way up. When it comes up, this first line is called the proximal line because it is within close or closest proximity to being reached. This line above it is called the distal line because it is a further distance away from current price. So this is called proximal line. This is called the distal line. Okay, let me go ahead and write that out for you guys here. So the first line that's closest to price is called proximal, and the second line closest to furthest away from price is called the distal line. Okay, so now let's go back here and see what we got here. So now when I'm looking at wanting to recognize, not only do I have my lines lined up properly, but do I have the right prices here indicated? So we have what we call quarters theory. The T stands for theory. So these are all theories. So quarters theory will have the pips. This is $1, 15 cents, and 71 pips. Okay, and so these pips would end, if it were quarters theory, if the institutions are targeting quarters theory, those pips would end with 25, 50, or 75. Now, if we're using, or if the institutions are using thirds theory, pips would end with 33, 66, and 99. If you're charting and you recognize a certain price, or you want to use a certain price range and you want to see what the institutions are targeting, they could be targeting a whole number theory, which would end in 0, 5, 10, 15, 20, so on and so forth, but it's a whole number. There's also a theory that I call 1585 theory, and so you'll see prices end with 15 or 85 pips, and the last one I call it rhyme or reason theory. And these are just my terms and phraseology to describe what I'm talking about. Now, this particular zone is identified, and I've come up to believe that this is the area using rhyme and reason. What do I mean by that? Well, the top line ended in a 71. I got the right ask price here, and I'm looking at this, and the very top of that wick is at 71, which doesn't fall in line with any of these here, these other theories, so it must be a part of rhyme and reason. Well, I noticed when I made it 61, it fell right at the top of the body of that candle. So I have rhyme, 71 and 61 rhyme because they both end in 1. And the reason why this is reasonable or acceptable is because they also are within a range of 10. 10 is a whole number. Please, please, please keep in mind, you guys are looking for these zones. Institutions are basically hiding codes in the charts. They're talking to one another. This is their language. These charts were not made for novice traders or for retail traders. It's a way in which communication can happen between parties, big parties, which are like institutions. And so for us to be privy to this information, it's only because you guys finally, for the first time, have access to people who are from Wall Street helping you learn this information. So please take this information very seriously, that these theories are being used, and it's like having codes. So rhyme and reason is what we see is happening here. And so we're going to go ahead and be okay with what it is that we're looking at as far as our zone. Now let's go ahead and go back and do the same thing for our buying zone. So before we get started, we want to switch our price to bid. because now we're going to be looking at prices that we believe the institutions are going to be targeting to buy. We're going to start with our 1 month chart. And as you can see, we don't see anything there. So we're going to drill down to the 2-week chart. Again, nothing here. If I wanted to, I could use this just for teaching purposes. I'll go ahead and do that. I normally wouldn't do that, but I just want to show you that's what we're going to be doing to narrow down our zone. So because this is a green candle, it has a tiny little wick there, I could actually use it, and this is our red candle. We want to do the opposite of what we did at the top. So to identify our monthly market reversal buy zone, this candle needs to be red, and the candle next to it needs to be green, and we need to put our proximal line at the bottom of the wick of the green candle, and our distal line needs to be at the bottom of the wick of the red candle. That's how you're going to identify your monthly market reversal buy zone. It's going to be the opposite for the monthly market reversal sell zone. All right. Because this zone is too big, as you can see, meaning the institutions, they're using quarters theory for the bottom of the wick of the red candle, and for the bottom of the wick of the green candle, we can see here that they are using whole number theory. But the range is too big. You're talking about 45 pips of a range here, and that's too big. So we need to drill down and go to a smaller time frame. So let's go to the 1 week, and we now can bring down to a smaller increment this range here. We'll bring it down to $1.12 and 23 pips, and we can see here 25, that's 48, something like that, about 48 pips. That is still too big. I think I added that wrong up here when it was up here. Yeah, that was really big. Let's go back to the 2 week, sorry. When it was on the 2 week, oh yeah, that was really big. So I miscalculated that. You're talking about just over, well, just over 150 pips. That's what this range was. And then now that we go to the 1 week, we were able to cut that down to now 25 and 20, that's 45, about 48 pip range, but we're still too big. And understandable, we are on a high time frame 1 week chart, so it's understandable that it'll be that big. So let's go to a 2-day chart. And wow, the 2-day really lets us narrow it down. So we're gonna bring down this proximal line to about here. When we bring it down to about there, we see that the price for the proximal line landed at $1.1186. I'm going to go ahead and edit that because I'm sure I didn't put it on there correctly. And now it's $1.1185. See, when you have a number that's close to one of the theories, just go ahead and edit it. So now we have $1.1185, which falls within the 1585 rule or theory. And then we have the $1.1175, which falls in line with quarters theory. They both land right on these candles. We have the red one first, the green one next to it, slightly above it. The range between these two is 10, and so that meets all of our qualifications. Now that we've been able to identify the monthly market reversal zone for selling and the institutional monthly market reversal buy zone, we're now ready to find our entries and our targets. So we'll go ahead and do that, and I'll catch you guys on the next video. Have a blessed one.